Hey everybody, today is March 2nd, and today we're going to talk about the stock market. Now, the last time we left off was in the middle of February, right? And we basically went below the 200-day moving average, and we defended this level by pushing it up higher. However, we tried to hold the level again, but we lost it and we moved down. And I said that in an update last week, we saw a strong bounce, right, after pushing down to the Fibonacci support level, right, which is right over here, right? And this big down day, but a big recovery as well, right? This bullish piercing candle, right, over here. That was the day that Russia decided to invade Ukraine, and so there was a lot of fear in the market. We saw a huge gap down, but the market quickly recovered as a lot of shorts got squeezed, and people were just covering their short positions, and I think everybody was just short at the same time. And not only that, but there was hope that there could be some peace talk resolutions, right? And so right now the market is trying to digest that, but also there is big news this month regarding the Federal Reserve, right? The Federal Reserve is going to meet in the middle of March, and there's going to be CPI data that comes out 1 week before that meeting. And that's going to be important because that's going to really foreshadow what the Fed might do, right? Are they going to be more aggressive with their rate hikes? Are they going to be more aggressive with their tapering? Or are they going to be more moderate and raise rates slowly over the year to try to beat inflation, right? To fight inflation. Now, this morning, the Federal Reserve announced that there are, because of the concerns of what's happening in Russia and Ukraine, that might affect the economy. We're seeing the price of oil directly due to the invasion, right? And all the sanctions that's being applied on Russia, right? We're seeing oil just spike up to over $110. I mean, it was over $100, which was already bad enough. And now it's $110. And that's going to put a lot of pressure on businesses. Supply chain, they're going to have to raise prices because those inputs are going to rise up. They're going to increase, right? And of course, that's going to put a lot of pressure on consumers. And there's fears that this rise in oil prices is going to reverberate across businesses, across consumers all around the globe, and it's going to lead to a recession, right? And yeah, so I do think that there's a lot of fear in that regard, and so the Federal Reserve decided that they were going to, instead of being more aggressive today, Jerome Powell said that he might consider just raising it 25 basis points instead of the 50 basis points, or even worse that people expected, right? People thought that it would be a lot worse, but they basically said that we believe that we can rate hikes, we can do height rates rate hikes in increments of a quarter percentage points, right? Which means that 25 basis points, or 0.25% rate hikes, and with the first one starting in March. But if inflation data is bad, meaning that if the CPI print in a few weeks from now is bad, then they might increase it more. So we're gonna have to wait and see what the CPI print says, and that's going to definitely have an effect on the market. But for now, the market is trying to recover from, of course, this correction that we've been in. This correction that's almost 20%, right? We're still not technically in a bear market. Bear market is over 20%. This is correction territory, right? Over 10%. And so let's look at the price action right now, right? We fell below the 200-day moving average. We fought back above, tried to stay above, but we failed over here, right? And of course, with concerns over the rate hikes, concerns over tapering, and of course the Russian invasion of Ukraine, now the market has been pulled back below the 200-day. So just on a technical basis, we are making some pretty good some pretty good progress right now. The fact that we've not only bounced strongly off the Fibonacci support level, which is support level here, right? But also we were, as the market was going down, we saw divergences in the MACD and the RSI, right? As the market went down even more, we saw the MACD go up and also the RSI go up, which I showed in this chart, right? Saw the price of the stock market go down, but also the oscillators going up. So that's a bullish divergence, which predicted that we would see a strong bounce after pushing down, right? And right now, the stock market, which is about to close in 5 minutes, is having a good day, right? The Dow is up 600 points. Everything is up almost 2%, right? All the major indices, right? The Dow, the S&P, and the Nasdaq. And so it's looking great. But however, even though we're making a good recovery, trying to bounce off the Fibonacci support level over here, we still need to reclaim the 200-day moving average, which is this blue line, right? Which we did over here, but we also failed over here. So now this is going to be a major resistance level, and we've had a cross of the 50 and 100-day. So we don't want to see this the silver line, which is the 50-day moving average crosses the blue line, right? If it does cross in the future, which it probably will, we do want to see the price or the S&P 500 go up and cross above the 200-day moving average, and that will in effect nullify the death cross, which is the 50-day crossing the 200-day, the silver crossing the blue line. And that's looking like it's going to happen sometime either this month or next month. So that's what we want to see in the stock market, right? We don't want to see this revisit down even further, right? Because right now the stock market, we're making lower highs and lower lows, right? Lower highs over here and lower lows. So to reverse this trend, we need to start making higher highs and higher lows, right? We need to move up, press down, and that's going to create a higher low and potentially higher highs, right? That's what we want to see. We want to see higher lows and higher highs to reverse the trend, right? If we end up not being able to recapture, well, first of all, we need to reclaim the 200-day. But if we are able to break above 200-day, the next level we need to reclaim is 460 over here, right? If not, if we roll over and push down, that's going to be a lower high and potentially a lower low if we break below this level, right? So at the very minimum, we want to hold our Fibonacci support level, right? And this is support level, and of course we saw strong bullish momentum coming in when it pierced below, and we ended up closing the day with this huge green recovery candle, right? Basically bullish piercing candle, right? Even though it's only up 1.5%, this thing plunged and then recovered a massive amount in just one trading session. So that should act as strong support if it does come down and test, but we generally don't want to see this thing come down. We don't want to see it roll. We want to see it continue up higher, break above the 200-day moving average, defend the 200-day moving average, and then work on breaking through the 460. And once we break through 460, we should have a good attempt at the previous all-time high around 480, right? So that's the stock market. Let's look at some of the higher time frame, right? The weekly for now is looking pretty good. It looks like we have a bullish reversal hammer candle over here with a pretty long wick, right? That's telling us that a lot of buyers came in at the last minute to push the price up. And but however, notice how we're still below the 50-week moving average, which is a silver line, right? And we want to break above that line and perhaps come retest it and push up higher. So, and that could form an inverse head and shoulders such as this pattern, right? And just to give you a better idea, right? Shoulder, head, shoulder. Sorry, kind of ugly. Shoulder, head, shoulder, and then push up higher, right? Something like that, right? We see an inverse head and shoulders possibly playing out. That can give us the higher lows and higher highs that we're looking for in a bullish pattern. And of course, break above 460 will give us more momentum to the upside. We also, not only do we have a weekly close, but we also had a monthly close. And give me a cleaner chart, right? We had two red candles. And if you look at the history of the stock market, it's fairly rare that we have more than 2 or even 3 red candles in a row, right? So there's a pretty high probability, especially that we see these big wicks, right? Over the last 2 months, basically January and February this year, we had a lot of buyers come in at the last minute to support these prices, right? So the fact that we've had strong buying momentum coming in, it does let me believe that the probability that we have a green month this month is a lot higher than lower, right? Yes, it is possible that we have a third red month. It is, but it's very rare. I mean, the last time we had it was March 2020. This is during the pandemic, where we had a worldwide shutdown, and the last time before that, was in early 2016. So you can see that over the last 6 years, it's only happened 2 times, right? Or actually, no, this year over here is 3 red candles in a row. But yeah, over this last 6 years in general, 5 to 6 years, we basically have we haven't had more than 2 consecutive red monthly candles, right, in a row. So I would say that it's pretty high probability that March is going to be good. However, like I said, there's going to be 2 major events. Well, I guess 3, right? Because we need to see how the crisis in Ukraine plays out, right? Is Russia going to back down, or are they going to escalate, or worse, are they going to bring out their nuclear weapons, right? If that happens, of course, the market's going to tank. And of course, there is the CPI print in a week or 2, and that's going to be very important because it will foreshadow what the Fed might do. Are they going to keep the 25 basis points that they just said they will do today, or are they going to be more hawkish and perhaps hike it up 50 basis points, right? Or worse. So that's the second thing. The third thing is, of course, the federal meeting itself, right? In the middle of middle of March, they're going to talk about what they are going to do in March and what they're planning to do going forward. And that's going to set a precedent to what we'll see going forward. And that's those 3 things are going to affect the market. And but in terms of technicals, the market is, for now, basically trending water, right? We at least need to defend this Fibonacci level. If we break below this level, it's going to be really ugly, right? But at least we're doing a good job bouncing and holding our previous or local low over here. But we want to hold this level and push up higher. So the bulls, what the bulls want to do when we come back next time is we want to break above the 200, at least break above and defend this level, right? We don't want to come back down again, right? Because the more we test support, the more likely we are to break it, right? We want to keep coming up. What the bulls want to do is keep putting pressure on the resistance level, the 200-day, and of course 460, which is the next higher low, right? This higher level over here. And once we do that, we can start to put in higher lows and higher highs and reverse this downtrend of lower highs and lower lows, right? Reverse this downtrend and push up higher towards new all-time highs. But of course, the first thing we need to do is get above the 200-day moving average, and that's what we're going to see in our next video. If we can get above the 200-day moving average, and I'll definitely update you with videos and charts. You can go on my Twitter page, and I'll put the links below, and that's where I'll put most of my charts. But for now, this video is going to give you a general idea of where I believe the market is going to go in the future, and where I hope we can bring the price of the stock market to the S&P 500 for the bulls to continue this overall uptrend, which still is in an uptrend, but we're in danger of reversing this macro uptrend to a downtrend if we don't reverse it soon. So let's see what happens in our next video and see if the bulls can bring the S&P 500 above the 200 moving average. If you found this video helpful, informative, useful, please like this video and leave a comment below. Thank you for watching this video. Thank you for all your support, and have a great day.